Good afternoon, everyone. Welcome to another edition of SRT Live. I am your host, Sean Richard, and I'm excited to be here with you today. Is the inflation peaking, or has it peaked? We're going to dive into that. Lots of information to go over today. We've had a pretty busy last week and a half since last Tuesday. So let's go ahead and dive right in with a recap and review of last week's numbers. So last week, we got a lot of inflation data. We got CPI, which is Consumer Price Index. We also got PPI, which is Producer Price Index. Consumer Price Index is inflation at the consumer level. And PPI, Producer Price Index, is inflation at the manufacturer level. So what do we get? CPI was expected to come in month over month at 0.2%, and it came in at exactly flat, 0 month over month inflation. Now, doesn't mean we're not seeing inflation. It just means that we saw no increase in inflation month over month. The previous reading was 1.3% month over month, so a significant reduction. Year over year, the market was expecting 8.7% inflation, and we saw that come in at 8.5%. That was a huge win, and we saw mortgage rates improve because of that reduced number. So inflation, hopefully, and appears to be potentially on the way down. Now, that's not going to be every category. That's headline inflation. And you have to go in and dive into the CPI report to break down to the different categories. But overall inflation down a little bit. Again, we got PPI as well, Producer Price Index. And that one, we saw a pretty significant reduction as well. Market analysts were expecting 0.2% increase, and we actually saw a 0.5% or 0.5% decrease in inflation at the manufacturer level month over month. Previous reading was a full 1%, so a pretty significant decline at the manufacturer level. Year over year, we saw 9.8% versus the expected 10.4%. So a huge decline at the manufacturer level. Now, just as a reminder, PPI, manufacturer inflation, doesn't always strictly correlate with consumer price index, consumer inflation. Companies have the ability to choose what they want to do with rising costs. They can, of course, pass them along to the consumer, which that would reflect in CPI reports, or they can absorb that cost and reduce their margins. And those are two really simple things that companies can decide to do as those costs rise for them. Last Thursday, we got jobless claims. This is initial claims, so individuals filing for unemployment for the first time. That came in at 262,000 week over week jobless claims. Previous reading was 248,000. So we're still seeing a slight increase in jobless claims, something that we want to pay attention to. And then we also got continuing claims, which is individuals renewing their unemployment benefits. That went to 1.428 million from 1.420. So a slight tick up in continuing claims as well. We also got the Reuters University of Michigan Consumer Sentiment Survey. And this survey is consumer optimism on the economic outlook. How do consumers feel about the economy moving forward? And it came in at 55.1, which was a surprise to the upside because the market analysts were expecting a 52.5 reading on that, which would still be an uptick from the previous month's 51.5. So we got a 55.1 reading. Consumers may be feeling a little bit more optimistic about the direction of the economy. We'll have to watch that on a month over month basis, as we all have a pretty good idea that we either are in a recession or very much likely heading into recession. We'll see if that optimism continues to push higher or if we see it reverse course. And then that was last week. So today, we actually got some housing data. We got housing starts and we got building permits. Now, quickly, yesterday, we got the NAHB Housing Index. That's the National Association of Home Builders Housing Index. And this is builder confidence or outlook about the housing market and new construction going forward. This is also a scale of 1 to 100. The previous reading was up at 55, but this month dipped down to a 49 reading. So builders not feeling as optimistic about the future of home building in the near term, and typically they typically have an outlook that tells us where the housing market is headed. So we want to keep a close eye on builder sentiment, just like we want to keep an eye on consumer sentiment about the economic outlook. All right. So housing data today, we got housing starts, building permits. Housing starts measures construction on single family homes. And that came in at an annualized rate of 1.446 million versus the expected 1.54 million. So housing starts down from expectations and down from the previous annualized rate from last month at 1.599 million. So we're seeing the housing construction or construction in the housing industry perhaps start to slow just a little bit, and we want to keep an eye on that. Building permits, which is permits on new construction projects. So this isn't specifically housing, residential housing. This really speaks to the overall trend in new construction, and the housing industry is really related to this, but obviously with new construction and new homes. But this gives us an idea of where we're trending from a housing industry by the number of overall permits on new construction projects, which of course includes housing. So we actually were expecting, the market analysts were expecting 1.65 million as an annualized rate. We came in at 1.674, so actually slightly up a little bit. So that could bode well for housing starts going forward. We'll want to watch that. All right. So coming up this week, we've got a pretty light week for the most part. Tomorrow, we've got the Federal Open Market Committee, the Fed, their meeting minutes. And although the meeting itself is going to bring bigger market movement, the meeting minutes give us a deeper dive into what the Fed is thinking, and it does have the ability to be market moving. So we want to be on the lookout for that. And as always, on Thursday, we get jobless claims, both initial and continuing. So that's coming up as well. So what are we watching for going forward? Well, as always, we're keeping an eye on inflation. We've got two more inflationary reports prior to the Fed's next meeting. Now, the Fed meets again September 20th and 21st, but prior to that, we've got the next CPI, Consumer Price Index reading or report on September 13th. And then later this month on the 26th, we've got, PCE, which is personal consumption expenditure. That happens to be the Fed's favorite measure of inflation. So we want to see where that comes in. And ultimately, we want to see if we continue the trend of inflation moving down. Is this going to be a trend, or is this a temporary dip? And we see that pick back up over the next 30 to 60 days. That's going to have a heavy influence on what the Fed does at its next meeting in September. The Fed is not anticipating getting to its 2% inflation target until 2024. So we are expecting inflation to decline, but the question really remains, is at what speed is it going to decline? Because mortgage rates are inhibited by rising inflation. So when inflation remains high, mortgage rates will typically remain high. But as we start to see inflation subside, we should start to see mortgage rates come down a little bit as well. I do expect that to happen into the end of this year, a slight bit, and I think we'll see that accelerate a little bit as we get into the second half of 2023. All right, on the housing front, as I just talked about, mortgage rates decline as inflation declines. So we're going to want to watch inflation closely in relation to the housing market. We're also going to want to keep an eye on inventory levels. We saw inventory pick up over the last 4 to 6 weeks. Are we going to continue to see an inventory climb into Q3 and Q4? Or is the inventory increase that we've seen really going to be chalked up to your typical summer buying season? So we want to watch that very closely to see where inventory levels come in as we finish out the year. And then I expect that we're going to see some renewed demand in the housing market. As we see inventory climb and as we see mortgage rates subside a little bit, we have a lot of prospective home buyers that have been sitting on the sidelines. They've elected to take a breather because of maybe higher rates, higher home prices, the incredibly demanding market that we've seen ourselves in over the last 6 to 9 months. And so they've taken a step back. As we see inventory stay robust or become more robust and interest rates decline, we could see some of these buyers come back into the arena, and that's going to have renewed demand. And we could see demand pick up a little bit from where we've been at over the past few weeks. I've actually got this great survey here. Let me show this to you. Boom. This is a survey uh, of real estate professionals. And this gives us an idea of what we're seeing across the country in or what the mortgage professionals and real estate professionals are seeing across the country from a shift in the market standpoint. So I happen to be in Texas. We're in the Southwest here. So as you can see here, um, the pricing pressure has actually gone has actually come down 68% in the long term here. Let's see. There we go. And we've seen activity come down 52%. I had, and I apologize. I had another chart that I wanted to show you that was really cool. I'll have to get that for you next time or post it in the comments. But check out this chart. This gives us a really good idea of what's going on around the country, the changes that we're seeing. Again, I'm not ready to call this a housing shift. I think we're normalizing. I think the market is softening a little bit because of the decline in demand and the increase in inventory, but I don't think we're seeing a complete shift. A shift would really be going from a seller's market to a buyer's market. And I think a lot of real estate professionals would agree that that's not the case. We're simply going from an extreme seller's market to a more normalized market, maybe with a hint towards the sellers as well. All right. And then the last focus that I want to touch on is employment. We're seeing increasing jobless claims trending week over week. We were down all the way down under 200,000 week over week for a while, and that slowly crept up. We're now north of 260,000 jobless claims week over week. So we want to watch that and see if that trend continues. Companies are slowing their hiring and in some cases laying off. Apple just recently announced that they are actually they've recently let go somewhere in the vicinity of 100 contract recruiters as they slow down their hiring. We've also seen job cuts from the likes of Peloton, Shopify, 7-Eleven, Tesla, Redfin have all let some of their people go. So we're seeing job reduction, slowing of hiring across the economy. And so that's all speaking to the slowing economy and a potential recession. So something else that we do want to keep an eye on. All right, gang, thank you so much for joining me. That is all I've had for you today. I appreciate you joining me on this episode of SRT Live for your weekly market update. Have an incredible rest of your week. As always, if you have questions, you can leave them in the comments below. You can always reach out to me at the number down below here. My team and I are here to help you. If you're a real estate agent, we want to help you do more and take care of more clients. And if you're one of our amazing clients, we want to make sure that you are able to accomplish your goals as easily and simply as possible. So don't hesitate to reach out with any questions. All right. Well, thank you so much for joining me today. Have an incredible rest of your week.